welcome back to our channel. Today we are diving into a topic affecting millions of students, that is educational loan. I know the word loan can sound scary, but hear me out. Educational loans can act as a powerful tool, opening doors to ample of opportunities that might be otherwise out of reach for you. Think about it. In 2023, the global student loan market hit a staggering $1.7 trillion with no signs of slowing down. Why? Because education, especially higher education, is still seen as a gateway to higher income and better job prospects. According to World Bank study, graduates with higher degree earn 67% more in the job sector. But let's face it, tuition fees can be brutal. In the US alone, average college costs have risen over 180% in the last 30 years. So that is where educational loan comes in. They act as a financial bridge, helping you covering expenses like accommodation, tuition fees, living costs, etc. Today in this video, we are discussing about an education loan scheme in detail. So don't miss out on any points. Watch this video till the end. And let's begin. Don't stress about the exact amount you need. This scheme specifically focuses on supporting your individual needs. So under this scheme, bank usually assesses your specific expenses like accommodation, living cost, tuition fees, etc. and they consider relevant guidelines and they can determine the ideal loan amount required for you. Also, there's a good news. Under this scheme, there is no cap on the total loan amount. Bank can tailor it according to your needs. For NRI students, you have different maximum limits depending on the type of program you choose. For regular institutes, the maximum is Rs 20 lakh, while top tier institutes, often referred to as premium institutes, it can go up to Rs 30 lakh. Remember, bank prioritize responsible lending, so the final amount will be based on your specific needs and financial situation. Let us discuss these eligibility criteria in brief. This scholarship is open only to citizens of India. You must have already been accepted into a higher education program in India or abroad. This acceptance should have come through a proper selection process like entrance exams or applications. You must have also passed any required qualifying exams like entrance test or standardized test. If you are an Indian student living abroad, you can still apply, but you must hold an Indian passport and your chosen program must be in India only. There is no restriction regarding the age under this scheme. Under this scheme, existence of a co-applicant is mandatory. So let me brief you about some of the criteria. The parents of the student has to compulsorily join in as a co-applicant. In the case of a married person, a co-applicant can be a spouse, parents or parents-in-law. In cases where both parents are not alive, a close relative or a guardian is to be taken as co-applicant. The co-applicant should be an Indian national. The courses covered in India are graduation, post-graduation, diploma courses from recognized universities, technical, professional or management courses, PhD courses. The courses covered outside India are graduation, post-graduation degree offered by recognized universities, certified degree courses conducted by CIMA London, CPA USA and other such institutes. PhD courses, diploma courses abroad are not covered. Don't worry if you haven't applied for a loan in the first year of your education. You can still apply for a loan under this scheme even if you are in the second year of your education. But remember, you need to assure that you haven't taken any loan from any sources for the same course. In simpler terms, this means you can still apply for an education loan even if you didn't get one right at the start. This applies to students who are already in the middle of their course, second year onwards. One important condition: you cannot have already taken a loan for the same course from another bank or financial institution. This is a good news for all those students who might need an extra financial support later in their studies. So if you are one of those students who didn't start with the educational loan but now you may think that you need that extra financial support, you can still avail this loan. Under this scheme, if your loan is 4 lakh, margin will be nil, and if the loan is above 4 lakh and it is taken to study in India, the margin applicable will be 5%. And if the loan is taken to study abroad, the margin applicable will be 15%. And for NRI students, irrespective of the amount, margin will be applicable 15%. Let me explain what margin is in banking terms. In Indian bank loans, the term margin can have two different meanings depending on the type of loan you are taking. Number one is margin in secured loans. This applies to loan like car loan, home loan or business loan where the borrower pledges an asset as collateral for the amount. Here, the margin refers to the difference between the loan amount and the market value of the collateral. Let us understand this situation with an example. You want a car loan of rupees 5 lakh. The car you are buying is valued at rupees 7 lakh. The bank might set a margin requirement of 20%. This means you can get a maximum loan of 80% of the car's value, which is rupees 5.6 lakh. Your margin payment would be rupees 1 lakh. Number 2 is margin in unsecured loans. This applies to loans like personal loan where there is no collateral required. Here, the margin doesn't have a monetary value but rather refers to the bank's assessment of your financial strength and creditworthiness. For example, you apply for a personal loan of rupees 2 lakh. The bank assesses your income, expenses, credit score and other factors. Based on your profile, they determine your credit margin, which reflects their confidence in your ability to repay the loan. A higher credit margin might allow you to access the full rupees 2 lakh, while a lower margin might lead a reduced loan offer or stricter repayment terms. Let me tell you the list of expenses which are included under this scheme. Number 1, tuition fees payable to college, school or university. Number 2, hostel or mess charges. Number 3, examination, library or laboratory fee. Number 4, insurance premium for the student borrower. Number 5, caution deposit, building fund, refundable deposit supported by institution bills or receipt. Number 6, purchase of book, equipment, instruments, uniforms. Number 7, purchase of computer, laptop at a reasonable cost if required for completion of the course. Number 8, travel expenses, passage money for studies abroad. Number 9, admission acceptance fees. So you can plan your repayment with ease. You will have a maximum of 15 years to repay the loan after your course ends and the moratorium period. This applies regardless of the loan amount you take. Remember, any interest that accumulates during the moratorium period will be added to the main loan amount before calculating your monthly installment. So, servicing the interest during the moratorium is recommended to keep your overall repayment burden manageable. In simpler terms, you get a fixed repayment time frame and flexibility in the loan amount, but always remember any unpaid interest during the grace period will ultimately add up and increase your repayment amount, total repayment amount in the long run. The rate of interest differ from bank to bank, but let me brief you about some of the common criteria that we can see Also, students who pay their interest regularly during their study period and moratorium period can avail special interest rebates. During your course and moratorium period, you will be charged simple interest, which means interest only applies to principal amount, not to previously accrued interest. This makes it slightly easier to manage payments compared to compounding interest. Once repayment starts, the interest rate switches to compounding interest, where interest is calculated on both the principal amount and accumulated interest. This means your monthly payment might increase if you haven't been servicing the interest earlier. So now let us discuss about the you can say collateral or security criteria under this scheme. So if your loan is up to 4 lakh, then you don't have to provide any collateral, but always remember your loan should be secured by CGFSEL. Now let me explain you in brief what is CGFSEL. CGFSEL stands for Credit Guarantee Fund Scheme for Educational Loans. It is a government-backed initiative in India that aims to make educational loans more accessible to students by providing a guarantee to lenders in case of loan defaults. Let us understand how this works. Students who meet the eligibility criteria and apply for an education loan under CGFSEL can access loans without collateral security up to a certain limit. If the student struggles to repay the loan and defaults, CGFSEL partially covers the outstanding amount, usually up to 75%. This reduces the risk for lenders and encourages them to provide loan to students who might not otherwise qualify. For students, CGFSEL offers peace of mind knowing there is a safety net in case of unforeseen circumstances impacting their ability to repay. If your loan amount is above 4 lakh and up to 7.5 lakh, then you have two options to secure your loan. Option 1, find a guarantor. You can go to the traditional route and get a trusted adult like parent, relative or guardian to co-sign the loan application. This person promises to take responsibility for repayment if you can't make the payments. Choose someone with a stable income and good credit history for smoother approval. Option 2. Choose CGFSEL. Instead of a personal guarantor, you can opt for government support through the Credit Guarantee Fund Scheme for Education Loans. This program acts as a safety net for the bank in case you default. While you still have to repay, CGFSEL covers a portion of the outstanding amount, making the loan more attractive to the lenders. So basically, you can either find a personal guarantor or rely on government support through CGFSEL to secure your loan. Choose the option that best suits your situation and comfort level. And if your loan is above 7.5 lakh, this option involves putting up some valuable asset like property, land or investments as a guarantee for your loan. Think of it as a safety net for the bank. This asset called collateral needs to be worth at least the full amount of your loan plus any interest that builds up during your studies and the grace period before repayment starts. So imagine you need a rupees 10 lakh loan. The collateral you offer has to be worth rupees at least 10 lakh, but also enough to cover the interest that accumulates. Say another rupees 2 lakh. In total, your collateral needs to be worth at least 12 lakh to qualify. Life insurance of the student is mandatory under this loan. So this was all about your educational loan scheme. Always remember, education is not an expense but an investment. But you should also do your research, compare your options and always prioritize repayment with an accurate schedules and don't default your repayments. If you have any further queries and you are based in Navi Mumbai, you can contact our technical team on WhatsApp. For our contact details, check the description box below. Smash that like button if you found this video helpful. Share it with your friends and family who might be on the same journey. And don't forget to subscribe to our channel to more financial wisdom delivered straight to your inbox. Remember, knowledge is power and financial literacy is your superpower.